Hey, what's going on, guys? My name is Dr. Boyce Watkins, and welcome to the Black Money Minute. I want to read something to you guys about an investor who says that he doesn't believe Tesla is still a good investment. This is from Market Watch. I'm going to break this down for you. A lot of you have invested in Tesla. Tesla's a great company. But according to this article, there are some hesitations that seasoned investors have about this company right now, and I'm going to read this to you now. Successful innovations make life better for customers, but that doesn't necessarily make those companies good investments. In some cases, innovation just helps all of us have a higher quality of life and doesn't mean that directly there's an investment or a company that flows from that tailwind, says Dennis Lynch, head of Counterpoint Global, Morgan Stanley Investment Management. His team runs several growth equity strategies for Morgan Stanley, including Morgan Stanley Institutional Inception Portfolio, which had an average annual return of 49.7% through the end of August, compared to 12.27% for the Russell 2000 Growth Index. Electric vehicles is one sector like that, and it's why he sold all his shares in Tesla several years ago. Lynch said that he owned shares of the electric vehicle maker in a small speculative position when the first Consumer Report review of the car came out about half a dozen years ago. At the time, the company started to have, quote, a real revenue stream in front of it, end quote, he said. The team sold the shares after about 3 years, missing most of the run-up in the car maker's stock price. In explaining his decision, Lynch said that selling cars is a tough business, and electric cars means selling vehicles that are expensive for the average consumer and require financing. It also comes down to one of his metrics he uses to value a disruptive company, focusing on unit economics. Tesla has a high capital intensity and constantly needs to get funding from the capital markets. That isn't necessarily bad, but it does put you in a position of potentially, during times of uncertainty, of relying on the kindness of strangers to continue that business model, he said. Lynch acknowledged that founder Elon Musk has done really amazing things, but he goes back to whether the company can be profitable. Quote, when you rely on capital markets and you're dreaming big, there's a fine line between inspiring and making promises that you can't keep, he said. Quote, we've been wrong in the sense that the stock price since we sold has done extraordinarily well, he said. But I think that's one area that it's really going to be hard to pick an ultimate winner, especially at today's prices, he said. Lynch spoke at a panel on disruptive companies with Bill Nygren, a high-profile portfolio manager and chief investment officer of U.S. equities at Oakmark Funds, a value fund manager. Nygren said his own take on disruptive companies, noting that investors often overlook the larger companies in the space that may be innovating themselves. One example is Allison Transmission, which makes transmissions for heavy-duty off-road trucks, including fully integrated electric axles, he said. The Oakmark Select Fund owns shares in the Indianapolis-based firm. So here's the deal. Here's what this article says, and you can read the rest. It's in Market Watch, and the title of the article is, "This is why this super successful growth investor no longer owns Tesla shares." And basically, it sounds like what he's saying is that Tesla has a really shaky business model, where if they have a bad quarter or the economy goes bad and it's not as easy to get the funding that they need, that could really disrupt things. Also, he's making a clear point that just because you're in a great industry, that doesn't mean that you're in a great company. And also, the company that starts that industry isn't necessarily the company that's going to be around 20 years down the line. So you think about the internet. When the internet came along, everybody knew that the internet was going to do well, but nobody knew what companies would dominate the internet. Back then, in the beginning, you had AOL and Netscape and MySpace and all these other companies that are now dead. They've been replaced by the Googles and the Facebooks, etc. Right? So be very, very careful when you look at emerging industries, because the industry may be great, but if you bet all your money on one pack of horses for one company, then you can end up struggling if that one company goes bad. Well, I'm Dr. Boyce Watkins. Thank you for listening. Please have a wonderful day. Happy investing. I hope you get rich. Love you guys. Peace.